Hi, everyone. We're just going to start in a minute or two. We're just waiting for some other people to sign in. So just sit tight. Thank you for joining, and just give us another minute or two. Thank you. I think we're going to get started. There's a few more people who are just signing in, so they'll join us as they become available. I want to thank you all for joining us today. We have an amazing topic that we're going to be covering, which is why invest in African consumer businesses and why do it now. During the course of this webinar, you're going to hear some amazing, knowledgeable people talking about what's going on in the African continent. This emerging economy is massive. It's so big that everyone's fighting for it, meaning the global players from the US, China, Russia, everybody's trying to position themselves here. And we have a couple of experts who are going to be giving us the benefit of their knowledge, both having, they're on the ground, they've been experienced investors who've been doing this for many years, have access to the right relationships to take advantage of this growing ecosystem, which is really it could potentially become the fourth, if you're talking about countries like China and India, Africa in an organized fashion could become the fourth economy, most industrialized economy eventually in the world. So we're going to hear all about that. We have Richard Okello, who's going to be our main presenter and speaker here. Richard runs Sango Capital, which is a group of funds, which has collectively about $500 million that they manage today and expanding. They're expanding one of their current funds specifically focused on the African consumer market. Richard has an amazing background. He started as an associate at a small firm that many of you may have heard of called Bridgewater, and he left as a partner from Bridgewater to move into this area. And prior to that, he was with McKenna Capital, which he also was there as a principal for 5 years. And Richard will tell you his background so you'll understand the depth of his knowledge. And as well, we're lucky enough to have Greg Dyra to also speak to us. And Greg is going to tell you not only about his background with Aubert Capital, which is his main company, where since 2010 he's worked with family offices, but what also he's going to tell you about his unique relationship to Africa and to a very interesting story he'll relate to you about Sango and how they have a retreat that he is going for the record on attendance on. So lots of interesting things that we're going to hear about today. I'm going to start by asking Richard to speak and tell us his background and then to provide us some information about where the African market is today and where specifically there are opportunities for investors such as you participants on the phone in the consumer market and how that's growing in Africa and getting very organized. So Richard, if you don't mind jumping in and giving us your background and uh, give us some information that none of us know, that would be wonderful. Oh, you're on mute. Oh, and I'll just ask everyone to stay on mute, please. You are automatically muted by the system, but if you could please stay on mute, that would be greatly appreciated.
Thanks very much, Milton. And thank you to all the participants who've made time to join us for this webinar. I'll take the next, say, about 15 or 20 minutes to just share some thoughts on the opportunity as well as the risks of navigating that. Just to add to what Milton said, I was born and raised in East Africa. I grew up in a small country called Uganda, and I spent the first portion of my career working in the US, initially for Bridgewater Associates for close to a decade, and then for McKenna Capital almost since inception, deploying capital globally. This idea for Africa was incubated out of my time at McKenna, and we started deploying capital while I was there into Africa. And I then left McKenna to set up this business, Sango, about 11 years ago. So that's the quick background on the opportunity set. So we've been deploying capital into this market, I'd say, for about 15 years. First few years while I was at McKenna, and then 11 or so years through Sango, this business. You know, we've learned a lot, we've seen a lot, and we're quite excited for where the market is going. I think as we have led a number of US institutional investors, some European, some Asian institutional investors, family offices, endowments, etc., into the market, our conviction has only risen. And so I'll walk you through some of those thoughts around risk and return and the consumer story, and then hopefully spend a fair amount of time on questions. So I think this chart for me is always a good jumping off point to contextualize the market that we're in. A lot of times when we speak to people about Africa, Africa tends to be sort of lumped together as this continent. The reality is, first of all, it is much larger than people think. And this picture will put that into context. This is a picture that is geographically scaled to its reality. And why is this important? It's important because it necessitates focus. It's too large to be covered as a single continent, so you have to pick your spots. And as I talk about the consumer opportunity, I will talk about the markets that I think it makes sense to be active in order to take advantage of the opportunity. The size and scale also implies two other things. There's a fair amount of complexity to it, but there's also a fair amount of differentiation. So the ability to build portfolios that can mitigate risk because they are diversified, structurally diversified, to find companies or to find funds that are structurally diversified, I think is very, very high in this geography. And anytime you've got scale and complexity, you've got opportunities to create alpha, to create real return, because you've got information asymmetries that are significant, you've got inefficiencies that are significant. And so you pull all that together, and we think Africa will be, we think it'll be the next big thing that you see people adding to their portfolios, for those of you that don't already have it. Now, as we think about risk and reward, I think the way in which a lot of investors have approached Africa has been in a linear fashion, which is, you know, sort of thinking about risk and return like this. If you're invested in the US, your treasuries are down here, low risk, low return. And most people think of Africa as being up here, high risk, high return. And we want to try to, I think, recalibrate that, because risk has changed significantly, both on an absolute basis as well as on a relative basis, relative to other markets that people are active in. And the reward and return and the things that drive that have changed, even with respect to the African consumer. So we'll spend some time on that. Let's maybe start with risk first. I think as we think about the different risks that investors get concerned about, I've listed a number of risks here. And I think it's important to start with risk because a lot of times we find that investors don't explore African opportunities primarily because the risks stop them. The risks are the key gating function. So we want to spend a little bit of time on the risks to kind of unpack a few of them, and then we'll go on to the opportunity set. So, you know, political risk, inflation risk, and currency are three risks that I'll focus on. Obviously, the other risks are relevant to the markets that people participate in as well. Now, when people think about political risk in Africa, I think one response we most often get is, essentially, doesn't Africa represent a concentration of political risk, right? That's sort of the view that people have as a function of the information sources that they receive. And if we step away from Africa for a second and we think of the world in which we operate today, this is a snapshot of political risk as you go around the world. And as you can see, going from left to right, whether it's, you know, an America that's divided, which presents its own sets of risks, or it's a China that used to be highly attractive and has become much more challenging as it's become authoritarian and unpredictable, or it's a Latin America that's very leftist, or it's Japan, and you just go down the list. And obviously the latest is the Middle East with rising instability. Political risk is on the rise around the world in most of the markets that investors spend time in. Now, if we think about Africa, Africa historically was synonymous with a lot of political coups, military coups. In fact, Uganda, the country that I grew up in, I remember in 1985, I think we might have had 3 coups in that same exact year. So that is how Africa was typically defined. But what has happened over time is that risk has diminished very significantly, probably much more than people think, because as it has diminished, reporting on it has become much less interesting for the media. And so as we think about political risk, and not just sort of political risk at the national level, i.e. presidents and elections and so on, but political risk as someone that's investing in private equity, we think that relative dynamic between Africa and the rest of the world that relative premium dynamic has actually become interesting for Africa, i.e. the premium on political risk in Africa is probably higher than it should be, and the premium on political risk in other markets is likely lower than it realistically is. As we think about macro risks, I think inflation is the one that's much more current for all of us. Obviously, we all know what happened in 2022. We saw inflation really make this generational leap that a lot of us hadn't seen in sort of our lifetimes or our investing lifetimes, and that reverberated around the world. And as we think about that, it used to be the case, so people would think of it this way, which is whenever you have these sorts of effects, huge rise in inflation, huge rise in interest rates, think of it as the US is having a cold or Europe's having a cold, and essentially, or is having a sneezing, and Africa should essentially catch a cold, i.e. the effect should be much more magnified in Africa. Now, as you look at the reality, which is much more important than as a private equity investor, here's what you see, which is if you look at how inflation has manifested globally and you say, which countries have been most shocked by inflation? You'll see on this page that a lot of African countries have not. Why? Because as fast-growing economies, inflation is an everyday phenomenon. What this chart shows you is it shows you the 2022 annualized inflation minus the 10-year average that each of those countries had. And as you can see, a number of these countries, African countries that you'd be participating in, essentially 2022 was a blip as far as inflation was concerned. Again, there a shift in relative risk there as far as inflation is concerned.
And Richard, just to ask you a quick question on the back on the political risk, is the by the way, I love that chart. It looks great. It's scary though that everybody is you're right. Your approach is right. In the African chart that you did, are there a certain percentage of the countries in Africa that are more risky and others that are less risky? And is that kind of where you've learned that the focus should be? For example, Uganda, that it's now able to be much more stable to make investments in, or perhaps Nigeria?
So I think that's a great question, Milton. And the short answer there is absolutely. So if you think of Africa as 54 countries, literally 54 separate, distinct countries, in our view, there are 10 or so countries that you want to be very active in. And then you could choose to be tactical in another, maybe 3 to 5. But it's really 10 countries. It's countries like, South Africa, where I'm sitting right now, very politically stable. If you think about countries like Kenya or Tanzania in East Africa, Nigeria or Ghana in West Africa, Morocco in North Africa, those sorts of economies are politically stable, but not just politically stable. I think those sorts of economies are ones where, in some cases, the political risk is still mispriced. And so the return you receive for being in those countries, the component of that is political risk, is higher than the reality, right? So you basically get paid more than you should because the markets are not really adjusted to reflect that quite yet.
So there's an arbitrage there for somebody who's knowledgeable.
There's an arbitrage, exactly.
Nice.
So that's political risk and inflation that we spoke about. And I just want to have a quick note on currency risk. Currency risk, I think, is a risk that comes up often, and it should. It's an important risk for anyone deploying capital into these markets. If you looked at this chart in 2008, when there was a global financial crisis, what you'd have seen almost discriminate selling off of currencies across all markets. There was not much differentiation between African markets. It was essentially the same. Now, fast forward to 2022, and this is the picture. And what you start to see is as these economies have developed, the way in which their risks get managed at the macro level is different. And their ability to withstand those risks is different. In the case of 2022, actually better where currency is concerned than some developed markets. You can see countries like Japan or the UK took a much bigger beating than some of the other African countries here from a currency perspective. And so again, from a thinking about how big is the risk in reality on an absolute basis as well as on a relative basis, I think what we would encourage you to do is think about how that is changing, how quickly that is changing, and the fact that there are premiums to be picked up for mispriced risk in Africa. And maybe just to switch then to return, which is really the large focus of this conversation. I think as we think about return, a lot of investors will be familiar with the broad Africa growth story. Africa is growing. I think the questions that people have are A, is it sustainable? And B, is it monetizable? Can I actually make money from that growth, right? Will it last, and can I make money from that growth? Now, if you look at, and this chart gives a very good picture of this. So 2019, so the COVID pandemic was actually a very good watershed moment. It was one where a lot of the world started to reset. We saw obviously China reset dramatically after that, and it hasn't quite come back yet. And so what this chart shows you is it shows you growth, real growth by kind of part of the world, 2017 to 2019 pre-COVID, and then 2020, that's including COVID, all the way to 2027. And I think two things stand out that we've highlighted in red, which is if you think about the regions that are flat or growing relative to their pre-COVID period, there's only two parts of the world, Sub-Saharan Africa and Middle East, North Africa, and Central Asia. Okay, so kind of carve out the North Africa component here. There are very good reasons for that, which we want to dig into. But the key is looking out to 2027, and obviously the IMF does these numbers every year, and so you can go out today, I guess, as far as 2028. The picture is similar, which is Africa is increasingly resilient and inching up while the rest of the world is slowing, with the exception of perhaps India, right? Now, the question then becomes why should that be sustainable? If you're a private equity investor or a consumer investor, you want to own the business for not just 2 or 3 or 4 years, you might want to own the business for a decade. Do you expect that growth to continue? So I just want to highlight a couple of key drivers there. I think that if we step back from the sort of the broader African picture, to our minds, there are 3 key things that drive sustainability of that growth. One, which everyone talks about, is demographics. So you got 1.2 billion people today. By 2030, we expect that will be 1.5 billion, so 300 million people added over the next 5 years. You've got a lot of those people living in cities. That is hugely relevant because when people live in cities, their productivity is higher, their incomes are higher, and their spending is basically higher. And then you've got the penetration of cell phone technology that is creating a lot of leapfrogging, probably much more than people who are not as active in Africa think. And I'll talk a little bit about that. When you take those 3 things, I think what you have is the dominant drivers of growth in African companies. So you get demographics, urbanization, and technology that's driving higher productivity and incomes and spending. And what you're then seeing is middle market companies are growing anywhere from 20 to 50% per year, sometimes 100% per year, sometimes more, because they're feeling these needs that people have in cities. You know, it's young families that want diapers, or it's people that need pharmacies, functioning pharmacies, or it's people that need grocery stores, and on and on and on. And for market leaders in those spaces, that consumer story is going to be fueled in a very sustainable fashion by those three themes. For those that execute well, I think then that creates the potential for outsized returns. Now, to dive a little bit into a couple of the drivers, I think the rapidly growing population and sort of the fact that it's urbanizing, I think, can be lost on people that do not travel there. And I don't know how many of the listeners on the call have traveled to Africa actively or recently, but essentially most African cities you go to today are clogged. You cannot get around. Everyone's got a car. There's too much traffic. There's a lot of economic activity. And the story is similar whether you're in larger economies like a South Africa or Nigeria or Egypt, or smaller economies like a Rwanda or other smaller economies. It's exactly the same story being driven by this rapidly urbanizing, rapidly growing population. If you think about the fact that in 1990, Africa was just 10% of the world's population, and 5 years from now, it will have tripled in size, right? Just literally added, more than doubled, tripled the number of people that are in the continent, and that path will continue. And more importantly, that a lot of those people are living in these dotted areas that I highlight. That's relevant because the ability to take advantage of the consumer story, it can be very efficient if it's focused on cities, right? You don't have to drive out all these miles into rural areas to find the consumer. The consumer is concentrated to these urban areas. Over the next 10 years, we expect roughly 400 million people to get added to the global labor pool that are Africans. So 400 million Africans working in all kinds of jobs. Some of those formalized in offices or running startups, running companies, etc. Some of those completely informal, selling, stuff in the market or whatnot. All of them making money, and all of them spending. That is basically the size of the US population added over a decade to this geography in terms of potential consumption. We think that is very significant. You don't really see this scale of increase in consumption around the world, and especially if this is happening every, call it 10 to 15 years, right, at a clip. Now, what this means then is that if you think about global consumption, we are at a pivot point. Coming out of COVID, Africa, which is the dark blue line here that you see, is really the only growing consuming line that you see. Okay, everything else is flat. Europe's flat. Latin America is flat. Asia is flat. The US is a mature market. Africa is expected to keep going up and essentially at some point meet or pass Asia. Okay, where are these people spending this money? Food and beverages, 40%. Utilities, transportation, a whole bunch of household goods and services, and on and on and on. And obviously the percentages will differ by country, but this gives you some sense for where the consumer needs stuff, goods and services, and where companies that can provide them are stand to make a killing. And if we were to zoom in for a second on retail, you're seeing the types of growth, the rates of growth that you typically shouldn't see in retail, and certainly don't see in developed markets that you now see in Africa. So markets like Egypt growing their retail at 20+%, and online retail really taking off in a big way that then is affecting sectors like packaging and you got discount retail and so on and so forth. So huge opportunities in sectors like retail, and I'll provide a couple examples there. I think the other thing to touch on real quick, and then we'll try to wrap it up for questions, is what has gone on with data and data access. And again, this is underappreciated and is a critical part of the consumer story. So in 2010, if you are basically flying way high above the African continent and could see the undersea cable network, this is what you'd see on the left. So data was incredibly expensive. This is all you had connecting Africa. In 2022, this is what it looks like. And the relative thickness gives you some sense for the relative bandwidth that's been added to Africa. What that then means is that the cost of data has dropped precipitously. So between 2016 and the start of COVID, data for most Africans dropped by 50%. It means affordability doubled, right? And you can see the spike. It dropped at the fastest rate in Africa relative to other markets. That combined with the fact that internet penetration increased, a lot of fiber to the home, fiber in cities, intercity fiber, and so on, and the cost of smartphones dropped, which meant Africans with smartphones went through the roof. It's very commonplace now to be able to buy smartphones in and around Africa for less than $100. A lot of people have smartphones. The implication of this on consumption is just unprecedented. It means that the way in which people consume is unlike what you've seen in other parts of the world. A lot of it is online. People live their lives through cell phones. They transact through cell phones. They don't just communicate, they pay. They educate their kids through them. They find doctors through that process. And so the implication then is that the consumer story is not just a brick and mortar consumer story. It's also an electronic consumer story. The benefit of it being electronic is that you can get hyperscale growth. When certain, and we've seen this with certain service providers who figure out how to unlock a way to make payments, and you will see them grow at 300% a year because of the demand that exists and the fact that it allows them to hyperscale as a business. Okay, so how do you take advantage of this opportunity set? And very quickly, we highlight two areas. Private equity and venture capital, we think, is how you want to do this. This picture gives you some sense for funds, GPLP funds. For those that are not as familiar with the market, there are lots of GPs in the private equity side, north of 200. The venture side today, it's somewhere between 80 and 100, kind of GPs. So there's a lot to choose from if you want to invest in funds. And obviously, for those that are bold enough to be direct into specific companies, lots of opportunities to look at. And then a quick note on the venture space, and then we can just pause there for questions. I think what we're seeing in the venture space is very interesting because it's quite differentiated than what you see in Latin America and, in Asia and the US, which is the venture model in Africa is not a Google model. It's typically not funds trying to find a Google in their portfolio. It's funds that are not taking a lot of technology risk. They're taking existing technologies, they're applying them to solve problems that people desperately need solved, and people are responding to that by growing these companies at very, very rapid rates. What that then means is that the typical loss rates you see in venture in Africa are quite much lower. So it's not unusual to find funds with loss rates of 10% or 20%. So very different model there. So that market, although it's small and nascent, I think remains quite interesting. Milton, maybe we should pause at this point.
Yes, I mean that's an incredible overview. I mean, you and I have been speaking, but I've still, every time I hear you speak about this, I learn a lot more. One of the questions I had is when you were talking about the currency risk, how hard is it to transfer your money out of the countries? Is there a lot of restrictions? I mean, look, there's restrictions in the US today. I was trying to transfer some money to Canada the other day, and I can tell you it isn't easy. So, but what are the currency restrictions in terms of transferring funds? You know, if you go to Brazil, very hard to get your money out of Brazil. So I'm just curious. Obviously, there's 54 different countries. There's probably 54 sets of rules, but in the main 10 that you referred to, what is that like?
That's a great question, Milton. So I think in summary, you can get your money out. We get our money out. I mean, if I think about what we do, we take money in dollars and we deploy it, and then we get it out, return it back to investors. So you certainly can get it out. I think there are some exceptions, and those exceptions are less about whether you can get it out and more about how long it takes you to get it out if you have to physically get it out. So I'd say, just give one quick example, a market like Nigeria has gone through lots of currency pressure. So people that are invested in Nigeria who have to get the money physically out, it'll take them long. It might take them 6 months to do it, but they'll still get the money out. However, in those sorts of markets, people invest into those markets through countries like Mauritius. And so if your ownership sits in Mauritius, then when the transaction happens to a seller, if you sell and you sell to a buyer, well, all that happens is the shareholding changes in Mauritius, the buyer just pays you offshore, and you don't actually have to physically take your money out, right? So in a lot of those countries, that's what you see going on. And we've done transactions like that ourselves in Nigeria in the last year or so without a problem.
Oh, very good. No, that's very helpful. I was wondering about that. As opposed to going into too many more questions right now, I'd really love the opportunity to hear a bit from Greg. Um, if you could take a minute, Greg, give us a much more detailed explanation of your background, as well as, where do you fit in investing in Africa? How have you made your investments, and how have you become knowledgeable about Africa?
Those are a lot of questions. Uh,
Yeah.
to summarize, I started my career as a CPA, so I'm a recovering accountant who went into investments in the early 1990s. And at that time, I had a chance to visit China, and I had a chance to visit Europe and Eastern Europe. And so I'm seeing a pattern that I recognized 30 years ago. Those places were had some of the same characteristics: urbanization. They were adopting mobile phones. They were seeing how the rest of the world lived, and importantly, they had an aspiration for improving their lot. I see a lot of those things when I travel across Africa. Of course, I've really limited my travel to the countries that Sango sees having tailwinds. So I haven't seen those countries that don't have those kinds of things yet. But I've worked in large endowments for a few years, 10 years between Northwestern University's endowment and Vanderbilt, which got me to Nashville, where I currently reside. For the last dozen years, I've worked with family offices, typically on their investment committees. And I serve on two unrelated family office investment committees today. One of those families has had a very strong interest in Richard in particular. I've known Richard for between 18 and 20 years. I knew him when he worked at Bridgewater and even at McKenna. And when we saw him making a big choice to spend his time in Africa, a place that he knew very well, we chose to follow him. We've been gone on 10 Sango business field trips over the last decade. There have been 11, so I haven't had perfect attendance, but I've had my fair share of lessons learned. My learning curve is very, very steep. Every time I go there, it's a terrific opportunity to observe, and I would encourage anybody on the call to consider traveling there at least once. But it's a tremendous opportunity to really observe the resilient entrepreneurs. You can't run a business in Africa if you can't be very nimble and among the most resilient business people in the world. It's really exceptional. We see families. I didn't know that there's been many, many decades, centuries of Indian merchant families really establishing businesses and creating economic growth on the east coast of Africa. But these are things as you travel, you observe and note that it's obvious when you've spent a little bit of time. We've also had a chance to really see government officials from time to time. It's nice to see the policymakers. Also, it's very nice to see the improving skill set of the policymakers. Government officials are coming back from London, from the United States, to help their governments and really establish great policy, better policy for the next generation. You also observe kind of what goes on in the street of each of the regions in Africa. As an example, in 2019, I had a chance to visit Tahrir Square and see the amazing political change that was enacted there more than a decade ago. But the action isn't in Tahrir Square in Old Cairo. The action today, the meetings, the dynamic energy is really in New Cairo. It's about 12 to 15 kilometers south. And if you're not observing Old Cairo and New Cairo, you're not really understanding where Egypt is going.
So on these field trips, what do you do? Do you go to see companies, or you meet with government officials, or just curious?
That's right. We do site visits. We visited pharmaceutical manufacturing companies. We visited beverage manufacturers. They bottle the beverages. We've gone to see toothbrushes and toothpaste, how that's how a company in Dar es Salaam, Tanzania was able to, it really was outrunning the Colgate Palmolives because they had access to the informal markets. They were able to distribute into 90% of the market. Now, over time, the formal markets, the retail stores, the Stop and Shop for those in the New York metro area, those are coming, but slowly. And you have to be ready to see the difference between informal markets and formal markets. But don't spend a whole lot of time with government officials, but it's quite packed. And the people that are on that trip are some of the most savvy investors that I spend time with. They are endowment and foundations. They are the World Bank Pension Fund is active. There are some family offices that tremendous people that they're sending. I don't know if I can mention a consultant in Boston, but it'd be known to everybody here. They manage their proprietary capital and they send their people on a regular basis on these field trips.
And how, I'll ask you this question. I'm sure Richard could answer it, but, as an American, I assume you're American, how do you see the U.S. influence in Africa? When you've been there, you said to 10 of these trips, you may have been there on other personal trips. How do you feel, as an investor coming into Africa from the U.S.?
Last month, we did have a chance to meet with the Consulate General team in Lagos, which was really exciting. And I would say that over the 10 years, I've seen more activity in the United States. I've been a little bit disappointed with the engagement of U.S. investors and to some degree European investors, although they're a little bit more active. It's just a lot easier to get to different points from London. But
Right.
I see China waning. China has put an awful lot of infrastructure. They've connected the coasts for sure to the rest of the world, and Africa will benefit from that investment. But China has behaved very poorly. Initially, they imported all of their workers, all of their materials, and did an end around each of the economies. The countries pushed back. There's a little bit of a better balance now, but you can see in a place like Angola, the Chinese have lost the ability to manage the rails, and the U.S. and the European JV is coming in and taking that over. I think there's a great opportunity for the U.S. to engage over the
Yeah, that's a major. There was just a big article in the Wall Street Journal about that just a few days ago or about a week ago, which is obviously indicative of what's happening. China spent a lot of time investing a lot of money, and apparently a lot of the infrastructure they put in is not really up to par. They're not maintaining it. I know the article gave an example of how they have a sign at one of the train stations that nobody knows the password, so they can't change it. So it shows the trains that's coming from 2012, and no one's been able to change it since then. So just
I've taken an informal survey over the decade I've been there, and I can't find any support. I was going to say widespread. I can't find any support for China is a great partner. China is our long-term partner. I think that they recognize that resources have been brought, and they're appreciative for that. But they're not anchored. They're not married to the Chinese infrastructure investment.
And have you found it more appropriate to invest through a fund structure versus perhaps direct investing? Because then you're investing with a team on the ground, so to speak, that knows how to handle any of the political risk that was mentioned, or even the governmental risk, I'll call it, meaning moving money around, getting permits, all of these things through the investments that they select.
Yeah, I think boots on the ground, localized talent is extremely valuable. I mean, I can't emphasize that enough. A team like Richard I've been able to. Richard's been really interesting to be a host in Africa because Sango hosts something called the GP Invitational. You have to be a good GP, general partner in private equity, in order to be invited around the Super Return Africa Investment Conference every year in Cape Town, South Africa. And Richard brings in private equity lessons learned from Asia, from other developing regions, and from developed markets. But everyone knows that when they go to the Sango GP Invitational, they're going to learn best practices. They're going to be able to find access to very high quality people. And I will say that I've been able to observe Sango for a decade, and they've been bringing highly qualified people. It's been a slow, time-extensive build, but very low turnover. They've been able to attract other Africans who are coming back with developed market skills. And there's no way that we could make these investments directly. We need a partner like Sango and like some of the other people that Richard brings to that GP invitation. We've had ample opportunity to meet tens, dozens of private equity firms, and we've really stayed very tight and close within the Sango network because we feel it's a trusted circle of investors.
Thank you.
I would actually add to that to say that I think that local dynamic is actually, it's not unique to Africa in the sense that if you are, I mean, in my previous life when I would invest in Indonesia or a place like that, if you don't know a local, typically the highest quality information flow is localized. And so you're basically out of the loop of that information flow. So if you think about political risk, the political risk in emerging markets, in my view, is often less about the election or, those sorts of things, much more about what is going on at the micro level. So for example, are you invested in a company in a sector where your competitor is owned by the son of some minister, for example, and they play by the rules, they just get certain preferential access, like they get to clear their goods at the border, whatever, 2 weeks before yours, right? And those sorts of things, that's highly localized information flow. So yeah, I cannot emphasize how important that is as both a risk mitigation tool, but also as a way to find the best opportunity sets.
Thank you. One of the things I wanted to ask you, Richard, is can you tell us about a couple of your best investments that you've made?
Sure. And I'll just mention Milton. There's a question I see in the.
Yes, I thought we'll get to it, but you could go ahead if you want to read what the question is and answer that, and then tell me about your best investments.
Sure. So the question is, how are geopolitical macro events, especially in North Africa, i.e. Egypt and Nigeria, expected to shape the investing and returns environment going forward from a PE point of view? It's a great question. So if I think about what's going on in North Africa, let's just focus on Egypt for a second. Egypt is under tremendous macro pressure, largely related to currency. And for Egypt, this is not so much a trade balance issue. This is not that the Egyptians just import a lot more than they export. It's actually much more of a capital account issue, which is they borrowed a lot of money to build infrastructure, to make these massive investments like the new Cairo. And they need to be selling assets to pay that down until those investments bear a return, right? Now, if I think about that type of macro event for Egypt, just today, I was on a call with one of our portfolio companies that is seeing unprecedented growth in Egypt. Why? Because the business is a discount retailer. So when a country is under pressure, guess what? People move down market in pricing, right? In terms of the goods they buy, where they buy them, and so on. And it also has a significant amount of its product as localized product. It's sort of an import substitution play. And so I think the way in which I'd respond to the question of Egypt, I think, is to say what it will mean is that the people that have strong performance, outstanding returns are going to be people that can find idiosyncratic opportunities in these markets. So it's not just a broad macro opportunity. Let's just buy Egypt, because then you're not going to make money necessarily doing that unless Egypt as a whole is doing really well. But there are idiosyncratic opportunities that are we now view outstanding in places like Egypt. Nigeria is similar, right? In Nigeria, they are, to use one example of an opportunity there, in the natural gas space. So Nigeria is going through a huge energy transition where they're going from diesel to gas to solar, right? In the natural gas space, companies like Coca-Cola have been running factories with diesel backup. You can't, I mean, this is like, if you just imagine what this looks like in a developed market, like Coca-Cola running massive factories with diesel backup and selling Coca-Cola at a crazy profit, right? They're deploying capital into these markets as fast as they can because they make a lot of money on Coca-Cola. Now, they decide to go to natural gas, of which the country has lots of it, but someone has to compress it and deliver it, and there's just not enough. I mean, we have companies we're invested in there that don't have enough trucks to deliver basic compressed natural gas. So again, I think the response I would have is that when you are, if I step back from the question and you could isolate those two markets, other markets, I think it's important to think of these markets as not just a broad macro opportunity set, but a real opportunity for people who can execute to find gems, of which there are tons of gems because the market's not crowded. You don't have a lot of capital picking over everything. And so the opportunity to find interesting gems, lots of them, and outperform in spite of what is going on is very high. And then maybe quickly, Milton, to talk about kind of some of our best investments. I think our best investment last year was a payments business that we exited at about a 24x return, 24 times money. Payments is interesting in Africa because if you consider the fact that if you say to yourself, 400 million people over 10 years get added to the workforce and they all make money, and maybe 15% of them have bank accounts. The rest of them they have bank accounts in the traditional sense, i.e. in a bank, in a physical building. The rest of them will transact on their cell phone. They will get their money deposited on there. They will borrow on there. They will make phone bill payments, utility payments. They'll bet on sports on their phone. They will, I mean, on and on and on, right? So this particular company basically keyed into that early and figured out a way with its technology to scale across multiple countries. Started out in Africa, very quickly expanded to select Asian countries, and then was acquired by a large global consortium. So that's one potential, that's one investment. Right? I think another investment that we have partially exited, but remains one of our best investments, is in the grocery retail space. And I talked about this earlier, which is, if you are when I lived in the US, most cities, like if you lived in a city on the East Coast or West Coast to San Francisco, something like that, the largest grocery stores in most of those cities would have they'd have 100, 200, 300 stores, depending on the chain, okay? And these are all cities that don't have, it's not like the city has 25 million people even, right? Not even 20 million people, it's a city, right? And the surrounding environment. We invested in Nigeria in a grocery play. Nigeria, 220 million people. When we started investing in the grocery sector, the largest store chain was 15 stores, 15, okay? 15 stores, mostly out of the city, right? So you have to have a car to get over there. You have to have bulk buying capacity to get over there, right? It's almost like the Costco model, right? US Costco model. Today, the business we built is 30 stores, so it's still tiny. Okay, that was an 8x partial exit in dollars. Okay, and what's particularly important about something like that is if you think about the effect that a grocery store has on people's lives, right? If you and I just think about what life would be like if we could not buy basic things close to us, like you could not buy veggies or bread, without traveling miles and miles, huge effect on people's lifestyles, but you get to make a very interesting return.
That's great. Thank you. I know we're getting close to the end of our time. One of the things I would like you to address just a little bit more is, you talked about the population growth and how, kind of one by urbanization, that that kind of drives more of this, which drives more of that and everything. But what is driving the growth? Is it just population growth? Is it also, modernization of technology, that people are becoming more aware of their options? How is the system being fueled? Are the governments able to sustain it? Meaning, can they afford to pay for infrastructure to keep growth occurring?
Great question. So let's start with the end of that question. What are governments doing, I think, to sustain growth? In my view, there are two things in general. One is ensuring that basic society functions function. Okay, so
Right.
so basic public healthcare works. The media functions, because then the private sector can just operate in that space very, very effectively without government intervention, right? That's
Right.
one. I see a lot of that. I think the second is governments have been very, very active infrastructure spenders. So if there's some numbers out there that suggest that Africa basically needs about $100 billion per year in infrastructure per year.
Sure, yeah.
And African governments are spending about 70 billion per year on their own in infrastructure. So call it 70% of that, 67% of that. Now the rest has to be borrowed or funded somehow. So they'll either borrow to do that, or it's privately funded, or there's a deficit. But this is the largest amounts of capital that governments have been willing to deploy in infrastructure in a long, long time. And so they're doing that because politically that's self-serving, right? You build a road, people see it, it's there, they credit you for it, they vote for you, right? Like, this is how it works in most of the world, and in Africa it's very, very relevant. Now, I think away from that, what's really driving growth is, given where a lot of African countries are, a lot of growth is a consumption cycle. So you have more people, right? That's the demographic story. Very high birth rate, lots of young people, which means the consumption rate is very high. The average age in Africa is about 17 years of age, 17 or 18 years of age. So if you're adding that many people to the system who are in that bucket, they're getting into the most productive years of their lives, the highly consuming parts of their lives, right? They're not sort of in their 60s where they're sort of not really consuming that much. And that's a huge consumption factor, okay? And that's ongoing. Now, those people could be getting added to the system with declining income. That would be a problem. Then you'd have a different dynamic around growth and different dynamic around stability. Because a lot of those people live in cities, and because they get to operate around leapfrogging technologies, you will see that income growth is quite meaningful for a lot of those people. It's not meaningful in the developed world sense, but it's very meaningful in terms of what they spend the money on. So you take those things together, that's your growth cycle.
Got it. Got it. Thank you very much. Unfortunately, we're running out of time. I could talk to you for a lot longer about all this, and I want to thank you, Richard, and certainly Greg as well, for your insights. And we will, in the event that people have questions, they can reach out to me, and happy to make the introduction to Richard, or we'll ask Richard perhaps to follow up with you all or his team in case you do have additional questions. And it's an amazing story about where this positive thing, something positive in the world that's happening. And it's like every other, opportunity, there's always bumps in the road. Nothing, the old expression, if it was easy, everyone would do it. But you're doing it successfully. So congratulations to you and your team. And I'll look forward to continuing our dialogue. And thanks everyone for attending today. We appreciate it. So we'll sign off. Thank you.
Thank you, Milton. Thanks, everyone.
Thank you. Bye-bye. Bye, Greg. Bye-bye. Bye, Rich.